For those of you who have not yet worked with us, Loeb Smith is an offshore corporate law firm with offices in the Cayman Islands, the British Virgin Islands, BVI, and Hong Kong, where we advise clients, especially clients in mainland China, Hong Kong, and Singapore, on investment funds, corporate mergers and acquisitions, capital markets, IPOs, finance, and other matters. This is the fourth webinar in the series where we've been discussing Cayman and BVI regulatory and compliance issues, and also discussing some of the creative and insightful solutions that are available for these issues. As we approach the end of 2022, in this webinar, we'll be assessing the many trends that we've seen this year for both Cayman and BVI funds, including the increase in the number of funds investing in Web3 technology and infrastructure, the continuing growth of funds in the digital asset space generally, the continuing growth of hybrid funds utilizing the SPC structure, and also the competition to Cayman and BVI for the domicile of funds from mid-shore jurisdictions such as Hong Kong and Singapore. We'll also look at the collapse of crypto exchange FTX and its impact on funds, if any. Some of the questions that will be covered include, will any of these trends continue into 2023? If so, which ones, and how will they impact offshore funds in Cayman and the BVI? We have Elizabeth Kenny, Liz. Liz is one of the high flyers in our corporate group in our Cayman office. She has a reputation as an excellent technical lawyer with a wealth of knowledge about the law and practice relating to Cayman funds. Liz joined the Loeb Smith Corporate Group in 2018 from KPMG Legal in the UK, having worked for KPMG in both the UK and in Milan, Italy. Previously to her career at KPMG, Liz was an attorney at DLA Piper in the UK. She currently advises on the formation and launch of Cayman funds of all asset classes, especially for clients in mainland China. Liz, excuse me, Liz, how about your practice? What are you seeing in terms of advising clients on the legal aspects of formation and launch of Web3 type funds?
Yeah, thanks, Gary. So we've had numerous successful fund launches this year. One key interesting thing we're noticing is the difference in the fund structures. So previously we had mainly like crypto trading funds, so they would obviously open as mutual funds because they're very liquid and they allow people to redeem. But now we're seeing a lot more private equity style investment funds. So we probably have seen about 50% have been structured as ELPs this year, and a lot more flexible structure. And the reason being that they're invested in more tech startup companies, blockchain startup, Web3. So they're not investing directly, but they're making investments through the companies because they see the long-term opportunities and growth. They want the longer capital commitments from the investors, and they also want the flexible structure in order to be able to give distributions to investors.
Thank you. I think part of my observation on the Web3 type funds is that there is no particular geographical sector or place where they're coming from. So like it's not that they are particularly sort of relevant or prevalent in mainland Hong Kong and mainland China, for example, and Singapore. What we're seeing Web3 type focus funds of different iterations. For example, in the US, particularly from California, from Switzerland, and other parts of sort of outside the EU in Europe. And also from places like Korea, for example, there seem to be sort of little hubs of areas where there's particular interest in Web3 technology and investing in the early stage, as I think someone said. One of the challenges that arises with regards to these is the types of funds that or the type of structures which are being used for these strategies. Liz, have you seen anything, any indication that there is a sort of movement from the traditional structure of, for example, GPLP for a closed-ended structure, or an exempted company for an open-ended structure? Are you seeing any divergence from that normal practice for these types of funds?
So for private funds, we're still very much seeing GP-LP structure, mainly because it's very familiar to investors and to fund managers. We have actually seen more SPC, so segregated portfolio structures as well, taking advantage of investing in private investments. So they've got a more flexible fund structure, which allows like multi-strategy funds. So we've seen more of that as well, but predominantly GP-LP structure for the private fund side. And then for the mutual funds, so the more liquid funds, we mainly see the exempted company and sometimes segregated portfolio company if they're slightly larger platform and they're likely to employ various strategies over the life of the fund.
Now, one of the factors that's been influencing, and I think one or two of you sort of touched on it just briefly, is the uncertainty or the sort of downward sentiment in the market in terms of confidence, driven by collapse or issues to do with some of the crypto exchanges or the more active crypto participants in the digital asset space. The most obvious one is FTX, which I'm sure pretty much everyone's heard of. What impact do you think, Liz, that this might have on investment funds? Or what impact have you seen so far this year, and what impact do you think it might have in 2023, if any?
Sure. So we have seen obviously the collapse of like Luna, Genesis, FTX. So the investor confidence is probably at an all-time low in terms of just the trading platforms generally, and it's the number one topic of conversation we have with any clients that are either thinking of or they have launched. Were you exposed? What are you doing about it? What's your investor communications like? In terms of any clients or potential funds that have been affected, there are key things to think about in terms of if you have assets trapped, what do you do about valuation, which also impacts your subscriptions if you can't strike your NAV, talking to your admins, your service providers, very much engaging early on if you see there's a problem or there might be a potential problem. And I think one of the key things it highlights is just being aware in terms of funds launching, what is actually in your funds document for your protections. So are you permitted to put in place temporary suspensions on redemptions and things like that? So it's almost a time for new funds to reflect on how do we protect ourselves in the best position. I've got new clients that are looking to launch soon, or they're still investing in different exchanges, and they're very much talking about enhancing their due diligence and their protections as they're investing so that they can report back to their investors as well. So I think as we see 2023, there'll be a lot more focus on due diligence, sort of safeguarding, making sure documents are watertight, and that there's a lot more focus on your diligence of your actual investments, your exchanges you're investing in, and your products. And it's one of the key things for CIMA registered funds. You have to have oversight over what you're doing, what you're investing in, the AML, KYC, and just general good compliance. So I think we'll see more of that, and just general corporate governance being tightened up. And that's one of the key focuses of CIMA for the next year as well. So I think those are the key things that we'll see going into 2023.
Liz, can you, have you seen this growth of hybrid funds, and what are some of the challenges that you see with these types of funds?
Yeah, I just reiterate what Clinton said in terms of the SPC funds. I've had very much like early stage discussions in terms of SPCs, which are hybrids, they're closed-ended, SP1, and then open-ended SP2, but very much discussion stage, mainly for the concerns from the client in terms of, well, how do we get our auditor admin on board? There's different valuation factors for a more traditional closed illiquid fund as compared to a open-ended sub-fund. So not so much in terms of the SPC hybrid structure, but we have seen existing clients who are crypto investing, and they're looking to, as part of their strategy, they've seen great opportunities as they've gone along, and they want to invest in more illiquid investments at early stage blockchain projects. So what we've been working with them is it permitted within your current documents? How can you allow that? And just building in like side pockets and a limit on like 10 to 30% on what they can invest in liquid assets, so they can still ensure that they've got the liquidity to meet any redemption requirements. So I'd very much say we're seeing more of that traditional hybrid structure within an existing fund rather than an SPC sub funds with different private fund and mutual fund categories.
Thank you, Liz. Derek touched on the point earlier that sometimes the managers, they try to hedge their bets by drafting the investment objective as wide as possible. The idea being that they give themselves sort of wide scope to do these various things. The difficulty with that is that the way the PPM is drafted can sometimes look markedly different from the pitch deck that was used to to develop investors into the fund. And so you might invest in a fund that you think are sort of trading public securities, only to realize that actually the vast majority of the assets are actually illiquid bonds. And I've seen examples of where the fund manager is saying, well, actually it did in the investment objective, it did mention bonds, but it mentioned sort of 100 other words, but bonds was in there, so that means I can that gives me the green light to sort of acquire a vast majority of a large portfolio of illiquid bonds. So it's always, from a legal perspective, it's always important, even for a fund which is not hybrid, to look at what the scope of the investment objectives and what the manager is actually saying that they can do, because that can give a sort of lead to certain understanding from the investor, which might not be what the manager's intended. So Liz, you're in the jurisdiction which is the world's leader for investment funds. I mean, Clinton mentioned sort of like 100. Correct me, Clinton, if I'm around 100. I mean, Liz, what keeps Cayman ahead of the curve in terms of funds? How do you see it sort of reacting to these new emerging jurisdictions like Hong Kong and Singapore, where there are advantages, some advantages as Alan and Clinton have outlined? How do you see the Cayman product or service, sort of, how does it stand up to that?
Yeah, in terms of Cayman, it's obviously at the forefront of the financial or the regulated funds. So there's about 85% in the world are registered in Cayman. So it's obviously got a very strong legacy and reputation for investors and for fund managers. But I think the one thing that stands out as well, just in the political climate, is the political stability and the good infrastructure and legal system of Cayman. It's based on, the English legal system. It's tried and tested, and there's a wealth of case law as well. So I think that just the robustness of the legal system and familiarity with fund managers and investors with the structures over here and the reliability. And I think also the service providers we have as well, which just make it a very valuable option. But in terms of some of the advantages I've read in terms of just the OFC, so for example, that you'll only deal with one jurisdiction, you won't have to deal with SEMA, for example, if your manager is in Hong Kong and your fund is in Cayman. I think one of the things that I've seen is that it is actually slightly more regulated than, for example, Cayman. So you do actually have to go to the SFC if you want to change your director, certain approvals. So I think it is actually slightly more regulated. Cayman comes under fire for being having a lot of regulation in terms of guidance, but I think where we're going to next year, 2023, is actually more helpful in terms of we have all this legislation, frameworks, funds are very aware that they need to comply and the obligations, but it's very much moving towards actually helping funds to manage their expectations, to make sure they comply and setting very clear guidelines. I think previously we had, these are the breach notices, enforcements, and it's sort of slightly scary for funds, but now we've got very clear guidelines on, for example, CRS and economic substance, so it is a lot more helpful for funds, and especially smaller ones that don't have necessarily in-house compliance legal advisors that can very much get to terms with it and then just consult with legal advisors as and when they need that sort of sign-off procedure.
Thank you. So I think the takeaway, my takeaway from all this is that Cayman is being, there are all these jurisdictions which are sort of popping up in terms of offerings. You have other jurisdictions as well, not just Hong Kong. I mean, Hong Kong has some of the advantages that you mentioned, like sort of follows the common law system as well, and is a pretty robust financial center. But I think the political political stability is one issue, which is always, at least the Cayman regulators or the Cayman sort of financial sector as a sort of promotional group. That's something that they always mention. In terms of these jurisdictions, though, I think the one thing to say is that they're all sort of getting to the stage where the regulatory differentials are going to be sort of lessened, and so it will become a sort of an issue about investor optics, or where do you think as a manager you can raise the larger pool of funds? Do you operate in a if you're hunting for for whales, do you hunt somewhere where there are lots of whales, or do you hunt there are lots of whales already? That analogy would be like Cayman, if you're looking for big investors, whether they be in Europe, and by Europe I mean non-EU Europe, or whether they be in the US, or whether they be sort of in the greater China region. The vast majority of them currently appear to be operating in Cayman, and to a lesser extent the BVI. But and so the last question is, are there any upcoming laws or regulations that in your business that you see that could impact, may impact your business next year, 2023?
Yeah, so in terms of Cayman, not expecting any new legislation. In terms of BVI, no new legislation. The only thing that doesn't directly impact funds would be the VASP Act, which should be coming into force in 2023. What I think we will see, especially in relation to SEMA, is more proactive guidance and helpful insights into actually matters that have come up from industry feedback. So we have seen in the last 6 months more like FAQs on the SEMA website, especially in relation to private funds. So when private funds came in, we had a raft of different guidance notes that came out into, can you commingle your assets within a brokerage account, because they have to have a custodian. So we've had a lot more guidance like that, and I suspect we will have more, and especially in light of the FTX, I think we may also have further guidance on terms of custodians, because a private fund has to have a custodian unless it isn't proportionate or legitimate to do so, given the asset class. So I think we'll see more things like that. I think we'll also see more guidance on corporate governance. There's a draft bill out earlier this year, which doesn't change anything drastically. It's not an increased burden, it's just codifying more so for help of internal AML COs, compliance officers, just to make sure that they've got everything in good order. So we'll see that come out probably, I would think, early next year. But just very much the sentiment is, it seems to be more collaborative and more sort of helpful approach. So I think we'll see more guidance notes and FAQs, things that are more helpful to industry, especially given the data collection and exercises that SEMA have carried out to comply with FATA. So I think we'll see things that are more helpful, more so than burdensome in 2023.
Okay, thank you very much.